Hi, it's Jocelyn with Just Accounting. I'm going to talk about how to account in your QuickBooks for the proceeds of the PPP money that you get. A lot of questions right now about now I've gotten the money, how do I log that in my QuickBooks or my accounting system? How does my bookkeeper log that in? So this is fairly uncharted territory. So I'm going to go through a couple different scenarios. So every company does their books just a little bit different. And depending on what you've decided to do with the PPP funds, I'm going to kind of go over some of the situations. So the easiest situation at the moment is I'm going to put scenario number 1. And I won't use the thing I did last week because it was backwards. But scenario number 1 is the money from PPP goes into your current business checking account, right? So if you see that, let me share the screen here. So scenario number 1, and I'm going to talk about scenario number 1 specifically and how to account for that. The money from your bank, so whatever bank you're using, gives you the money, and my bank said, we don't have to start up a new account. You can put it in your current account, and as long as you're keeping track of all of your expenses, we're fine with the reporting as long as you can provide documentation. So let's say, for example, you have the money and it goes into your PPP, the money from PPP goes into your current business checking. So here's the QuickBooks. So let's say, for example, this is your QuickBooks, and you have a bank account. So this is the accounting of a bank account. So I'm going to do some quick accounting here. So let's say I didn't have a bank account. So let's say we have this is our business checking account. I made a test company just because it was easier. So now you have a checking account, and let's say it's a transaction. You get your money here and you're going to deposit. We're going to go with a $25,000, right? And so this is technically, remember, this is in your current checking account. There's a couple different ways you can handle it. You could put it as owner equity. Let's see if they have owner equity in this one here. So this one doesn't have owner equity. And so let's say this is an equity account, because essentially it's not income, it's not a loan. Right now, as it stands, we got the money. It belongs to the owner, depending on what kind of company you have. So I'm doing an S corp right now. Let's say owner's equity or whatever. So this is the PPP loan proceeds. You can call it grant, you can call it loan. It depends on how you use the proceeds. This is why the accounting of this is so crazy, because depending on how you use the proceeds, it might turn into owner's equity, but it also might turn into a loan. So if your money comes into the bank account and you are fairly certain, let's just say that you're fairly certain you're going to use it all, like 100% certain you're going to use it all, I would say need to be at least 100% certain to put owner's equity. Then put owner's equity, make the note, and move forward from there. Now, what you need to do is, let's say our first payroll of 3 employees is $10,000, let's say. So you need to create, typically you'll do payroll, you'd have payroll expenses. That's your normal one. Don't do that. Don't do that. I would not recommend that. So you normally have payroll expenses. You might run the payroll, it'll go through. You could even have it run regularly with your payroll company or whatever. But at the end of the day, you need to change the category to say PPP payroll. This would be my suggestion. You don't have to follow it. It can be under payroll expenses, right? So you don't necessarily have to create a whole new thing, but you want it to go as a PPP payroll so you can run the report. Key is making sure you're running the report for the bank, which is what part of the requirements for the verification that it's going to be an owner's equity and not a loan. So we got payroll expenses, so you go like that. Then, in a week or two, you have another payroll of $10,000, right? And of course, if you know how to run payroll, you know, this is kind of going quickly through it. So you're going to, again, do payroll expenses, PPP payroll. So, and you're going to keep doing that. Then you have to pay rent. Obviously, I'm going very fast on this accounting. Then you're going to pay rent. Let's say your rent is $1,500. You would typically have a rent expense, right? Don't put it under rent expense. Don't do it. You want to create a new account that's going to document so that you can easily document when these things came out, and it will still, when these things came out during the 8 weeks of your PPP window. It will still be deducted as an expense on your tax return. That's where you don't want to mess that up. You don't want to not take it as an expense necessarily. So the rent and the payroll expenses. So the problem is, if it turns into a loan, obviously these are deductible. And as far as I can see, they're still deductible even if it's not a loan. That's really not been answered by most of anybody that I've seen any documentation. But right now, I would put it, this is another reason why we're going to document it out specifically for PPP, right? So depending on when they give us additional guidance on this stuff, after the 8 weeks is done for you, you'll know how to expense it differently. So then let's see, the last thing we could, healthcare. So let's say you have 100, you know, let's say $10,000. Do we have 10,000 left? Nope, we only have, let's say we have 1,500 of medical. Or health insurance. They don't have either one of those. So let's say health insurance. But we're going to do PPP health insurance because hopefully you're paying for health insurance with your people. So then you go here, you have $2,000 left. When you're running, so now here's where it's very important. When you're running the report, you want to be able to pick out the different PPP expenses, because that bank is going to ask for every verification you've ever done for PPP. And if you've rolled them all into regular expenses, it's going to be much harder to run a really nice, clean report for them. So you can double click on the PPP payroll, boom, here's the checks, here's the expenses, here's the payroll for the 8 weeks. Because you documented it properly, it will save you time and energy, and you won't have to be like, I don't know, I didn't do it right, blah, blah, blah. And now it becomes a loan. They're like, great, no problem. You didn't document it. We don't care. Here you go. You got to pay it back now. You don't want that. So you want to document it in your accounting as PPP. Now, do you want to put it all under one PPP heading? That's up to you. Do you want to do multiple PPP headings? Also up to you. So if you want to just do one PPP heading and have that under PPP expenses, and then do payroll, rent, insurance, you're welcome to do that too. It just depends. So what you want, the end game is to get a profit and loss report at the end of the 8 weeks so that you can detail out to the bank the day, the time, the check, the amount, and obviously be reconciled. So you need to reconcile these things. So this is scenario one. Money from PPP goes into your current bank account. Now, then you ask, well, what if I have $2,000 left? What if I have $2,000 left? Now what happens? Now you need to go back to this place up here, you know, and you can change things a little bit different. Let's see here. So this was a transfer from the owner's equity. So let's say we go back into the chart of accounts and we go into the owner's equity. So all accounting softwares have a double entry system. And if you don't know what that is, you need to, well, hire a bookkeeper. You should be watching anyways. But if at the end of the day, you don't have you owe money. So you do owe $2,000. The $25,000 would stay as an owner's equity because you did get it for free. But now $2,000 of that is going to be a loan. So now you need to create a loan. It's going to be called a loan, other current liability. And there you go. That's going to create a loan. And now you have a current liability that you owe money to, that you're going to pay back. So then when you go into your checking account, you're going to have in 6 months, which is when it starts. So let's say 11/01/2020, you're going to have to pay $2,000 into your PPP loan here. Okay? So now in your loan, it's off. So we've got to figure out why the owner's equity is off by 2,000, which it would have probably come out. So you make a mistake, it's totally fine. Owner's equity is 27,000. Oops, better put it in as decreased because owner equity decreased, the loan increased. Making a mistake with accounting is not the end of the world. Knowing how to fix it will be very important. So owner's equity was 23 now, the PPP loan has now been paid off. That's confusing, go back and watch the video again. So that's how you kind of created the loan, and then when you pay off a loan, it's going to go to the PPP loan. So how do you know when it's going to be a loan? That's why the beginning part is so important, to make notes of what is actual PPP expenses for the loan proceeds and how you can use them, because the ending balance is going to be your loan. So hopefully that helps on that situation. So let me see here where we had this. So so money from PPP goes into your current banking account. And that's kind of how I would do the owner's equity potentially. So scenario number 2, you open up a new bank account, but you're running your expenses through your current checking. So of course, sometimes everything's linked to your normal checking account, and then you open up a new bank account, which some banks, I guess, are saying you have to do. So are you going to start moving everything through this new bank account, rerouting all your routing and account numbers? Let's say you don't do that, and you're not going to do that. And you're going to just write yourself a reimbursement check on the expenses you wrote out of your current checking account. So at this scenario, you're going to add a new bank account. And this I would call your whatever, let's say you use CPP, and this is going to be the PPP account. So specifically set up for the PPP account, right? So you've got one specific checking account, which you need to reconcile still. No, don't look my bank. So now you have one CPP checking account, and the bank entered, let's say they put in, they deposited, because it's just going to hit your bank account. They're going to deposit $25,000 into your account. This is the harder part. So how are we going to do it? We're going to put it in as owner's equity. If you have, you could put it in as other income. You could put it in as a PPP loan. But theoretically, this is your PPP loan, right? So you've already created a bank account that is the loan, theoretically. So let's just say you go with income, even though on your tax return it needs to be other income, so that you can determine whether it would be taxable, which it won't be taxable. Let's just say PPP proceeds. This is another way you could handle it, but you got to be in strict contact with your tax preparers so that they know to back it out. It's not other income. It technically is owner's equity. But if you don't want to go in that messy area and you don't understand how it's working, it might be easier to go this way for some people. So let's say it's this way. And then you are running everything through your regular checking account. And you're going to write yourself a check of, let's say it's $5,000 for your payroll. What would happen here is you're going to transfer. You're going to transfer the money from the PPP. It's not going to be an expense. So remember the scenario. This is open up a new bank account. You're running expenses through your current checking, not through the bank account. So you're writing a check to self, essentially, right? You're writing a check to yourself. You're transferring the money, which how you transfer the money goes to the other checking account. So then you're in the checking account here is where you're going to still show, these are the ones from the other, so we're going to delete these from the scenario 1. You don't want these. Delete. delete, delete. Okay, so now you have, we're going to delete this too, because this was from scenario 1. So, this was deleted. So right now, if everything was the same, of course you have all these transactions. So you have a self-checking deposited in from your PPP account, which is a new bank account. Now all of a sudden, you're getting $5,000 more in your regular checking account. It's not income, and as long as it's gone into the PPP account, you are now going to transfer money into your regular checking, and then you're going to run payroll of the $5,000, and you need to expense it out as PPP payroll. No matter what you're doing, when you're actually coming down to the rubber meets the road for the expense, please detail it out as a PPP. Otherwise, you're going to have a hard time reporting it. So at this point, we've got $5,000 as a PPP. So let's say we run a P&L and we do all of it. You've got $5,000 of PPP and other income of $25,000. So at that point, if you want to run these two numbers together, it gives you an idea, which this helps you show on the P&L how much you have left. Not necessarily the most accurate way to do it. This is just kind of a weird situation at the moment. These will not be income unless you understand how loans turn into income, which is a whole nother conversation, because a loan is money you have to pay back, and at some point you have to get income for that to pay that back. A little bit of an accounting lesson there, but this at least will tell you how much you have left on your loan and how much you need to spend, right? So that's kind of how you would document these within this scenario. You open up a new bank account and you're running your expenses through your current checking. So number 3 is you open up a new bank account and you are running all expenses through the new bank account. So it's going to be fairly similar to what you did when you were running it through the regular checking, except a lot of people don't realize you are going to need to reconcile this. So any good bookkeeper will make you reconcile these things. So you're going to have statements for the 2 months. And then at that point, you're probably going to close the account. So if you've been running payroll and things like that, and you decide to change the routing number to this, please, please, please make sure you're running your payroll through a PPP. It's going to be the same thing. So if you are going to run your expenses through the PPP account, let's say you have $5,000 as payroll. Okay, and then so this is the same, this is one ledger. You're not kind of transferring money back and forth. It's one ledger, one bank statement. You've decided to run all your things through this. So you've got rent, but it's PPP rent. These are the ways you're going to be able to document it on a P&L as well. So this will be the 5,000, the 1,500, and etc. So then you just list it, and it'll tell you kind of in one ledger what you have. Now, if it turns out at the end of the day and everyone decides, wait a minute, you got this money and it was free, you don't get to take these deductions, right? Not sure how they're going to categorize that, because you're going to get a W-2, you'll get 941s, you're still going to show you paid these things, right? You'll get rent. So if it turns out at the end of the year, everyone decides, no, none of the PPP stuff that you got reimbursed for is an expense, I'm not saying that's going to happen. I'm just saying it's a possibility. I've not heard any documentation, but I could see that happening. Then you're going to have to put this into owner's equity and take the expenses out of owner's equity. Not saying that's going to happen. Nobody said anything about that yet. I don't think people have understood how accounting works quite yet for this stuff. So there's been no direction as far as I can tell. Doesn't mean I know everything. It just means I foresee that happening. Because basically you're double deducting at that point. You got the money for free and you got the expenses to deduct. So essentially you got, instead of $50,000, $25,000 free money, you got free money plus $25,000 of a deduction on your tax return, which maybe that's the point. Typically that doesn't happen, but if that did, that'd be great. So this is what you would do if you were running everything through one bank account that opened up specifically for the PPP. And it will tell you at the end of the day how much you have left. And then at the end of the day, if you have money left, you do need to create an account for the loan. So close out the bank account. You would put it into your checking, theoretically, or you just give that money back, right? So if it turns out that you're just giving that money back, then it goes straight to the PPP loan, which you'd have to create the 18,500 in order to close out that double accounting. I'm so sorry, this is kind of difficult, but that's how you would close out the bank account. You would be paying off the PPP loan, which at that point you need to close out as well over here. So we did the 16,000 and you close it out for, that was the old one. So that's that scenario. If you're setting up a new bank account, running all expenses through the new bank account. The third way to kind of do it, if you wanted to, if you are running, another way to do it is using, so if you run it through your current bank account, this is just another way. Doesn't mean all the ways I'm saying are wrong or right. There's multiple ways to account for stuff. Run your money through current bank account, and you know it's going to be a loan, right? So let's say you got the money and maybe now your business exploded and you know it's going to be a loan. You have to pay it all back. At that point, you don't necessarily want to put it in as owner's equity or other income. You're just going to come here and you're just going to say, I got a loan, and then you're going to start paying it back when you need it, right? So hold on one second here. Edit, delete, check. We're going to delete these old scenarios. So you're going to come and you're going to say, I got the money. I got, let's say 25,000 or whatever yours is, and I don't need it, right? In the accounting world, if you're opening up a loan account, it has to have a corresponding account to go to. So you would do it as an owner's equity, let's say, because a loan would technically be kind of income. So then if you know in a couple of months, now I'm going to start paying that back. Now all you've got to do is write your payment check of $5,000 or whatever it is. It goes straight to the PPP loan, and voila, you have your loan is down by $20,000 to $20,000. So you start paying that off whenever, let's say, November shows up, and you didn't need it, and you decided I might need it in November. I'm going to keep it as a loan. So then you start just basically transferring that from your checking account to the PPP loan. So that's that scenario. If you just know it's a loan, as loan, if you know it's going to be a loan. So the problem with this money is it can be categorized as a loan. You could say, so some accountants might say, no, it's going to go in as a loan, and then anything you don't have to pay back, we're going to put as owner's equity. You know, like we'll say that's not a loan, right? That's a way to do it. It could be categorized as other income. Maybe not the best way, but at least you're documenting it on the P&L, and you can kind of see that go up or down as that on P&L, right? The other way is owner's equity, which that is a way to put it in without documenting it as a loan. So you could go put it in as a loan, and then everything that you pay off is going to become owner's equity, or you can put it in as owner's equity, and everything that you don't pay off is going to be a loan. If you weren't confused after that, come. Let's talk. I guess the other things you could possibly put it in loan, income, owner's equity. The thing is, QuickBooks and accounting in general isn't set up for free money, right? It's set up for these categories: fixed asset, current liability, equity. You could start it as an opening balance equity, but it's not an opening balance equity that you necessarily, it's an owner's equity. It's not a free money. You'd have to decide where it came from. Equity, income, and expenses. You see here, there's no place for free money. So typically free money that kind of doesn't have a place to go, like retained earnings, which is this idea of money that is earned but not necessarily going anywhere. These kind of things here. So there's no place that says like a grant or free money, right? That typically businesses don't get free money. You're going to get something that you can apply to another category that is one of these. At the end of the day, you want to get a report for the bank so that you don't have to pay it back. That's the end of the day. I don't know how they're going to account for the W-2s, for the rent. Are you going to be able to deduct them? Theoretically, at the moment, you should be able to deduct them, even though it was free money. Those are different scenarios I can think of. It's April 29th. If I find some more scenarios, I'll let you know. Have a great day.